Okay, this video covers accounting for restructurings. And restructurings are when a company decides to exit or dispose of certain elements of their business, and that includes layoffs and asset disposals and contract terminations. And they incur costs when they do these restructurings. And so how do companies account for these restructuring costs? And I'm actually going to take you now, we're going to take a look at the actual accounting rules from the Accounting Standards Codification. Okay, so now we'll take a look at the actual accounting rule that governs how to account for restructurings. And so here it is, Accounting Standards Codification, the paragraph number. I'm going to give it to you. It's 420-10-25-1. And this is just determining when to recognize a liability for these future costs that we're going to incur in our exit of a certain business operation. So a liability for costs associated with an exit or disposal activity shall be recognized in the period in which the liability is incurred. And so that is nothing new. That is how we account for all other types of liabilities as well. As soon as our company has an obligation, we record a liability on our balance sheet. That is not new. But there are certain one-time employee termination benefits, okay? There is an exception here for one-time employee termination benefits that we're going to go over in the next slide. So let's go to the next slide. So some costs we account just normally as we do other costs and liabilities. One-time employee termination benefits, it's a benefit to the employee, right? It's a cost to the company. How do we account for those? Okay, so ASC 420-10-25-4, one-time employee termination benefits. An arrangement for these one-time employee termination benefits exists at the date the plan of termination meets all of the following criteria and has been communicated to the employees. Okay, so we're going to fire, unfortunately, companies are going to fire employees sometimes, do layoffs. So we're going to lay off 1,000 employees. And that is going to cost us, right? We're going to need to pay severance and other types of costs that we're going to promise employees in return for the unfortunate layoff. And so when should we recognize those anticipated costs as a liability on the balance sheet? Well, these 4 criteria. Management having the authority to approve the action commits to the plan of termination. So management, whoever that is, decides that this layoff is certainly going to occur. Okay, that's one of the conditions. The next is that the plan, the layoff plan, identifies the number of employees to be terminated, their job classifications or functions, and their locations, and the expected completion date of the layoffs. Okay? The plan establishes the terms of the benefit arrangement, including the benefits that the employees will receive upon termination, including but not limited to cash payments, in sufficient detail to enable employees to determine the type and amount of benefits they will receive if they are involuntarily terminated. And so B and C just talk about, is the plan specific enough so that we and the employees know exactly what costs are involved. And the last condition, D, actions required to complete the plan indicate that it is unlikely that significant changes to the plan will be made or that the plan will be withdrawn. Okay, so if all of these conditions are met, we'll actually record a liability before we've incurred the costs. Okay, liability before incurred, I-N-C, that's a U, okay, U-R-R-E-D, the costs. Okay, so what type of cost would we incur? Well, once we lay off the employee, now we owe them the severance benefits, right? So typical accounting rules would say, okay, as soon as the layoff is executed, then the employee is owed their severance benefits, and that's the time when we have the obligation. Well, these restructuring rules say that you'll actually recognize the liability before then. You recognize the liability as soon as the plan is in place. That's when you set up the liability on your balance sheet. And it's a debit to restructuring expense on the income statement and a credit to a liability account on the balance sheet. And what I'll show you is an example of restructuring occurring at GoPro. So you may or may not remember in 2016, GoPro came out with a new camera line that just was not selling very well at all. And they had to slash the price in half, and nobody was buying this new camera line. And they, as a result, restructured a certain part of their business to reorient it to a different line. And so this restructuring involved layoffs. So here's just from the footnotes of GoPro in 2016. Here's what they say. On November 29th, 2016, the company approved. Okay, so there's that plan. They approved a restructuring plan. So that is indicating that the criteria have been met. Okay, this restructuring plan must be specific enough and it's been approved by management. And so even before we've done the layoffs, we being GoPro, we're going to record a liability. So the company approved a restructuring plan to reduce future operating expenses. The restructuring provided for a reduction in the company's global workforce of approximately 15%. That's a lot of employees. The closure of the company's entertainment group to concentrate on its core business and the consolidation of certain leased office facilities. So they were doing cancellations, asset disposals, and more importantly, employee layoffs. The following table provides a summary of the company's restructuring activities during 2017 and the related liabilities recorded in the accrued liabilities on the consolidated balance sheet. So remember, this plan was approved prior to December 31st, 2016. And so as of December 31st, 2016, the total liability balance was 10, and this is in thousands. So this is $10,539,000, okay? And so what must they have done before that first date on the table, okay? So the first date on the table is December 31st, 2016. In November, they approved this restructuring plan. So how did they set up this initial liability in November? So in 2016, they set up the liability. They debited restructuring expense on the income statement and credited restructuring liability on the balance sheet for $10,539,000. And that's how they established this liability in 2016. So as of December 31st, 2016, here they have a credit balance and liability account of $10,539,000. Well, during 2017, some events happened, right? So the first thing that happened is they realized that their liability wasn't big enough. Okay, so the $10.5 million that they estimated that the restructuring was going to cost wasn't big enough. And so they had to add to that liability during 2017. So during 2017, they did this journal entry again. They recognized more expense on their income statement, and they increased their liability by $3.1 million because the restructuring ended up, the estimate went up from what it was at the end of 2016. The second thing they did during 2017 was they actually paid out some of these benefits. So they actually incurred the liabilities and paid out to the employees what they owed them. And so the amount of cash that they paid during 2017 was $13.2 million. And so is cash involved in this next journal entry? Yes, it's going out of the business. So it's a credit to cash. And we're also going to reduce our liability because we're making good on our obligation. So we'll credit cash $13.2 million and we'll debit the restructuring liability, reducing our obligation because we're settling it for $13.2 million. And there's a final line here that happened in 2017, non-cash reductions. That might be payment in kind or something like that. So I know that this is going to increase the liability because it's increased liability there in the table. As you can see, it's a positive 17. So it's a credit to the liability, but I don't really know what that relates to. It's a small number, so we don't need to worry about what that 17, what the debit would be in that case. Okay, so here's how GoPro accounted for their restructuring. And the short answer is that as soon as management approves a restructuring plan, even if the company hasn't incurred the liability, they immediately set up a liability and debit a restructuring expense account on the income statement.